Trading does not work, and that's simply because traders do not benefit from possibly the most powerful force in the investing universe. Charlie Munger already said it. There are huge mathematical advantages to doing nothing. And I have run the numbers, and in this video I will show you with the help of a few simple examples why trading is the vastly inferior investing strategy, especially for the average investor. I will show you that even if a trader generates exactly the same annual return as a long-term investor, the trader will end up with a much worse financial outcome. And if you wonder why that is, stay tuned, and so let's jump right into it. Okay, shortly we will look at a few examples that are going to be truly eye-opening. We will look at 3 different investing strategies: short-term trading, long-term trading, and long-term investing, and compare the results of these 3 strategies. But before we do that, let's first of all clarify what the difference between trading and investing actually is. Generally speaking, investing and trading are 2 different methods of attempting to profit in the financial markets. When you are trading, you are buying and selling assets based on expected short and near-term price movements. So traders attempt to take advantage of both rising and falling markets over a shorter time frame, sometimes a few minutes, sometimes days, months, or quarters. And thus, traders take smaller but more frequent profits. And broadly speaking, traders are also often less concerned about the actual fundamentals of the underlying asset, and they use technical analysis tools such as moving averages to find high probability trading setups. Now, by contrast, when you are investing, you are more concerned about the fundamentals of the asset. If you invest in stocks, for example, you are buying an actual stake in a business and you make that investment based on the expected long-term cash returns of that business. And you possibly think there is a high probability that the intrinsic value of that business will go up over time. So naturally, investors, in contrast to traders, well, they take action less frequently and they have a longer time horizon and seek larger returns over extended multi-year periods. And that's especially the case if you are following a quality-focused buy and hold approach and not a special situation strategy, which may be shorter term in nature. So with these technicalities out of the way, why do I think that trading is the vastly inferior investing strategy? Well, I will do 3 things to illustrate the rationale behind this opinion. First, I'll share a quote by Phil Fisher. Then I'll discuss the most overlooked fact about how Warren Buffett amassed his fortune. And lastly, and maybe the most interesting part of this video, I will do some calculations to prove my point. So let's start with Phil Fisher. He said, "It is just appalling the nerve strain people put themselves under trying to buy something today and sell it tomorrow. It's a small win proposition. If you are a truly long-range investor, of which I'm practically a vanishing breed, the profits are so tremendously greater." What Fisher is referring to is that oftentimes the richest and wealthiest individuals on this planet are the ones that started the earliest and waited the longest. For example, as of 2022, Warren Buffett, arguably the most famous investor of all time, has a net worth of around $100 billion. But did you know that Buffett was worth only $3 billion when he was 49? What might be an even more shocking statistic is that 98% of Buffett's current net worth has been earned after his 52nd birthday. So clearly, Buffett has accumulated his massive wealth because of the power of compound interest. And of course, someone who is trading for a long time, maybe 4 decades, can also benefit from this powerful force. But there is a problem. And that's the first rule of compounding. You should never ever interrupt it unnecessarily, which is a famous quote by Charlie Munger. So how do you interrupt compounding unnecessarily? Well, there are a couple of ways to hinder this beautiful wealth building process. For example, if you own a stake in a truly world-class business that keeps growing its intrinsic value every single year, you are interrupting the compounding process by selling the stake you own in that business, maybe the entire stake or a certain percentage of your stake, maybe to rebalance your portfolio. Well, you are interrupting the compounding process. But there are other factors that can interrupt the compounding process as well. And those factors are often overlooked. Namely fees, which of course should be kept to an absolute minimum, and taxes. Taxes interrupt compounding growth as well, because when you are selling an investment at a profit, you usually have to pay taxes, capital gains taxes, in most countries. Belgium, for example, may be one of the few exceptions. And Charlie Munger understood this early. There are huge advantages for an individual to get into a position where you make a few great investments and you just sit on your but you're paying less to brokers, you're listening to less nonsense, and if it works, the governmental tax system gives you an extra 1, 2 or 3 percentage points per annum compounded. Make sure to read this quote again. Trading less frequently can give you an edge of 2 to 3 percentage points annually. I truly believe that the impact of taxes on your investment returns is vastly underappreciated. So let me illustrate this with a spreadsheet that I have built for the purpose of this video. So what we will do is we will look at 3 different investing strategies, 3 different scenarios. Short-term trading, long-term trading, and long-term investing. In all 3 scenarios, an initial investment will compound at the same rate of return. For the purpose of this video, we will choose the market average of 10% annually. However, in the first scenario, the investor is trading the position once a year and thus paying short-term capital gain tax. In the US, gains you make from selling assets you've held for a year or less are taxed at the same rate as your ordinary income, anywhere from 10% to 37%, depending on your total taxable income. For the sake of this video, we will go for 35%. And if we now assume your initial investment is $100,000, then after 1 year, your net worth will have grown to $106,000, after 5 years to $137,000, after year 15, you're worth $257,000, after 30 years, $661,000, and after 40 years, $1.24 million. Let's compare this to a longer term trader that trades the investment once a year, but just after each 12-month period, so that he only has to pay the long-term capital gain tax, which is between 0 and 20% in the United States. Let's go for 15%. Well, his net worth will grow to $108,000 after year 1, $150,000 after 5 years, $340,000 after 15 years, around $1.1 million after 30 years, and $2.6 million after 40 years. So you can see that he is already doing better than the short-term trader. And in our last scenario, the compounding process is not interrupted at all, and taxes are only paid once at the end of the investing period. Now, if that investor would stop investing after 1 year, his net worth would have grown to $108,000. If he stopped after 5 years, $151,000, $370,000 after year 15, $1.5 million after year 30, and $3.8 million if he cashed out his investment gains after 40 years. So what these numbers illustrate is that even though all 3 investors earn exactly the same annual rate of return, their final financial outcomes are completely different. After 40 years, the net worth of the long-term compounder investor, this could be someone who simply invests in a broad-based ETF, is more than 3 times larger than the net worth of the short-term trader. Let me say that again, 3 times larger. And just to be clear here, there are different styles of trading, and most traders buy and sell stocks much more frequently than only once a year. I have also calculated the compounded after-tax returns for each scenario, and here you can see that Munger is right. If you invest for the long term, the governmental tax system gives you an extra 1, 2 or 3 percentage points per annum compounded. What's even more incredible is that the patient long-term compounding strategy would still outperform the short-term trading strategy if the investor generated an annual return of just 7%. I think that's absolutely insane. Now, if you want me to play around with the spreadsheet, you can leave a comment down below with the initial investment that you want me to use, the annual return, as well as the short-term and long-term capital gain tax. I will plug these metrics into the spreadsheet and I will let you know how the financial outcomes would look like. And if you want to learn more about why exactly the average holding period has declined significantly over the last couple of years and decades, make sure you watch the following video next. Take care.